All right, in this unit, we're going to be talking about what are futures. Futures are contracted agreements that obligate parties, investors, or producers and users to buy and sell an asset at a predetermined expiration date and price. There are futures contracts for physical commodities such as oil, precious metals, meat, sugar, and grain, and there are also contracts for currencies, equities, indexes, and interest rates. The futures market is all about balance. The essence of the futures market is balance, and it was created for producers and users to hedge against major fluctuations in the price of the underlying asset by the agreed upon expiration date. Quick example with these pictures would be the producer of grain and the user of grain, aka a bread maker, creating a contract to hedge against the unforeseen price increase of grain that might influence the business profits from a bread maker. So suppose there's a market for crude oil, and there are those that produce the oil and those that use the oil. In the simplest terms, the producers want to be able to sell their product at the highest price possible while satisfying the demand of their users, and the users want to be able to buy it as cheap as possible, or at least at a price that allows them to continue to conduct business. When we factor in the unknown of time, a user of crude oil is not always certain that they'll be able to buy all the crude oil that they need to continue to operate at the current profit margins that they're used to. In order to protect themselves against a potential future price increase in crude oil, one that might put them out of business, they can enter into a contract with a producer of crude oil to lock in the purchase of a specified quantity at a specified price at some later date in the future. Now, while they might miss out on some potential profit increase that comes with the associated underlying asset price drop, they can continue to conduct their business knowing that the future supply of the product that they need is protected against any major price increase or decrease. This is often described as hedging.